Hello. Welcome to the very first episode of the mortgageQ podcast. This is where we do a weekly deep dive into the mortgage space, not just the headlines, but the forces shaping how loans are originated, how banks adapt, and where mortgage professionals can find opportunities in today's economy. Now, let's be honest. Mortgage professionals rarely get content built just for them, but they're the ones shaping the industry, helping borrowers secure homes, guiding banks through risk, and driving the market forward. This podcast is designed to keep loan officers, brokers, and banks up to date with the trends, news, and opportunities that matter most. And right now, there's a shift happening, one that's worth slowing down and really paying attention to. I'm Jason, and I've been in the mortgage industry for 25 years through the highs and the lows. My goal with this podcast is simple: to cut through the noise and give you insight into where the mortgage world is headed. And joining me today is my co-host, Rachel.
Hi, everyone. I'm excited to be here, especially because today's topic is a big one. Non-QM lending, that's non-qualified mortgages, has just hit a record high. For the first time ever, they account for about 8% of all mortgage rate locks.
Yep, that might sound like a technical detail, but it's not. It's a signal, a turning point in how people are getting financed in 2025. And we're going to break it down.
Let's start at the basics for listeners who may be hearing this term for the first time. Jason, what exactly is a non-QM loan?
Good question. Non-QM stands for non-qualified mortgage. Simply put, these loans don't follow the stricter underwriting guidelines set by Fannie Mae, Freddie Mac, or the CFPB.
So it's not about bad credit, it's about not fitting into the standard documentation box?
Exactly. Think of the self-employed borrower who doesn't have W-2s, or the investor who relies on rental income, or even freelancers and gig economy workers whose income is real but inconsistent on paper. For these people, a traditional lender might say no, but a non-QM loan says, show us your bank statements, show us your 1099s, show us your property cash flow. It's flexibility built for the modern economy.
Now here's the part that really stands out to me. Mortgage activity overall has dipped, but non-QM lending is rising. What does that tell us?
It tells us a lot. It's a contrast worth paying attention to. Purchases and total locks went down, but non-QM reached a record high. That means borrowers are actively searching for alternatives, and it's up to loan officers and lenders to be ready with solutions like non-QM.
So this isn't just one-time spike?
No, it's demand. It's reality catching up with how people actually work and earn in 2025. The old way said, if you don't have a steady paycheck from an employer, you're too risky. But in today's world, entrepreneurs, contractors, investors, they're not risky, they're essential.
So it's a mindset shift. Instead of forcing borrowers into one mold, lenders are realizing they need to adapt. Okay, got it. Moving on. Something else caught my eye in the latest reports. Refinances are making a bit of a comeback, especially cash-out refis. What's going on there?
Yeah, cash-out refinances were up about 5%, and rate and term refis saw a bump too. This points to two realities. One, borrowers are reacting even to small rate improvements. Two, many are under financial pressure and looking for liquidity.
And that's where non-QM loan products come in again, right?
Exactly. If you can't walk into a bank with perfect tax returns, traditional refinancing may not be an option. But with non-QM tools like a no-doc HELOC or a bank statement refi, loan officers can now help clients tap into their home equity without forcing them to refinance out of their low-rate first mortgage.
So it's a financial lifeline for people who otherwise would have been stuck. Now let's flip this around to the brokers listening. If you are only offering traditional loan products, what's the risk?
The risk is simple. You're leaving deals on the table. We're no longer in a market dominated by cookie-cutter deals. A huge and growing segment of borrowers now fall into the non-QM zone.
Okay, so it's not just about being competitive, it's about staying relevant.
Exactly. At mortgageQ, we've already leaned into this space by building a platform that makes it easier for banks and loan officers to deliver solutions like bank statement loans, DSCR products, and no-doc HELOCs. Because the truth is, not every strong borrower has a perfect tax return, As an originator, you need to recognize real-world ability to repay, not just paperwork.
And that's a big takeaway. It's not high risk and it's just smart adaptation. All right, Jason, let's wrap this up. For loan officers and brokers tuning in, what's the message you want them to leave with?
If you're a loan officer or broker tired of turning down solid borrowers because they don't fit the conventional mold, it's time to rethink your toolkit. Non-QM is growing fast, and mortgageQ is here to help banks and originators capture that opportunity.
And if you've been sitting on the sidelines waiting for the market to make sense again, maybe this is your signal.
Absolutely. Non-QM lending isn't niche anymore. It's mainstream, and the sooner you understand it, the more opportunities you'll unlock.
And that brings us to the end of episode 1 of the mortgageQ podcast. If this gave you clarity, share it with someone. And don't forget to subscribe.
Yep, this show is about more than loans. It is about giving mortgage professionals the knowledge and tools to navigate a changing market and serve their borrowers better. And that's exactly what we're building with mortgageQ, a software platform designed to help banks and loan officers stay ahead. And this is just the beginning.
All right, thanks for joining us, guys.
All right then, I'm Jason Nichols.
And I'm Rachel, and we are signing off from the mortgageQ podcast.
Until next time, see you soon.